Sam Bankman-Fried, the young emperor of cryptocurrency, lost everything overnight and was arrested. How could such a colossal empire collapse so rapidly? In just a few years, FTX, with a market capitalization approaching 7 trillion yen, declared bankruptcy within days. Investors worldwide had their assets frozen, and the losses were immeasurable. Yet, in truth, this failure harbored structural causes that continue to recur in the modern era. Regulatory loopholes, overconfidence, and hidden fraud. What precisely triggered its downfall? This video will unravel why success became the seed of failure, what was overlooked and by whom, and the crucial lessons modern economics must learn. Now, let's delve into the full scope of the FTX collapse. In the main segment, we will further explain the young founder's character and the astonishing reality of his asset concealment. In 2019, Sam Bankman-Fried, known as SBF, founded FTX. He recognized the potential of cryptocurrency at a young age, garnering attention for his intelligence. In just a few years, FTX rapidly grew into one of the world's leading cryptocurrency exchanges. This surge was fueled by exceptional trading algorithms and service designs highly attractive to users. In 2021, FTX invested in Super Bowl commercials and enlisted celebrity ambassadors. The FTX logo became a ubiquitous sight at sports events and esports venues. SBF was also actively involved in philanthropic activities, espousing effective altruism and making substantial donations, thereby earning public trust and goodwill. He also engaged in vigorous political donations, forging relationships with influential figures in Washington. He actively dialogued with regulators, establishing himself as the face of the industry. He was portrayed by many media outlets as a savior, accelerating cryptocurrency adoption, with his assets reportedly exceeding 2 trillion yen at one point. FTX aimed to be more than just an exchange. It sought to become the center of the cryptocurrency ecosystem. Its affiliated company, Alameda Research, played a core role in this ambition. SBF, achieving success at a young age and captivating global attention, had a bright future, with everyone anticipating his vision. He was truly the young emperor of cryptocurrency. The key to FTX's success lay in ensuring customer fund liquidity and offering complex financial derivatives. It particularly earned the trust of institutional investors. Preempting competitors, FTX built a flexible system that responded to customer demands. This drew massive amounts of capital into FTX. Sam Bankman-Fried, leveraging his insights as a financial elite from Wall Street, accurately grasped market movements. Alameda Research, under his leadership, functioned as FTX's primary market maker, bringing enormous liquidity to the exchange. Skilled marketing strategies and brand image construction were also factors in its success. This contributed to heightened interest in cryptocurrency, particularly among younger demographics. Proactive dialogue with regulatory authorities also served as a differentiating factor from other exchanges. Its forward-looking stance as an industry leader was highly valued. It also succeeded in attracting talented personnel by offering high salaries and luxurious offices to employees. The organization appeared rock solid. Up to this point, everything was smooth sailing. FTX had solidified its position as a key player shaping the future of the cryptocurrency industry. Behind this success, FTX and Alameda Research had forged an unusually close relationship. Customer funds and Alameda's assets had become ambiguously intertwined. Alameda was making high-risk investments using FTX customer assets as collateral. This was, in essence, tantamount to unauthorized use of customer deposits. SBF issued large quantities of his own FTT token, accounting for it as an Alameda asset. Furthermore, a precarious cycle of borrowing had begun, using FTT as collateral for further loans. As long as the cryptocurrency market was robust, this scheme remained hidden. However, with the market cooldown, Alameda's accumulating debts began to swell. Internal oversight mechanisms were largely non-functional. SBF and his close associates controlled all decision-making and began rejecting external audits. Many of the executives were SBF's friends or former colleagues, with few daring to challenge him. Groupthink created an environment ripe for overlooking illicit activities. Dialogue with regulators was also merely superficial, with the true reality concealed. This lack of transparency became a distant cause of the subsequent grand collapse. But here, a pitfall no one noticed had opened. Its depth was beyond imagination. SBF's pretext of effective altruism was highly likely exploited as a justification for his own illicit conduct. FTX employees, too, were captivated by SBF's charisma and unquestioningly believed in the business's success. The immense wealth blurred their judgment. The entire cryptocurrency industry was in a period of rapid growth, fostering a climate where some risks were deemed acceptable. This obscured the internal malfeasance. To cover Alameda Research's mounting debts, FTX illicitly diverted customer funds. This act is the most unforgivable for any financial institution. The value of FTT tokens was sustained not by substance, but by trust in SBF. The moment that trust collapsed, everything disintegrated in a fragile structure. A suspicious tweet from Changpeng Zhao, CZ, CEO of a rival exchange, concerning Alameda's asset situation, triggered the chain of collapse. Customers panicked, rushing to withdraw their funds en masse. A bank run ensued, and FTX's financial liquidity deteriorated rapidly. SBF frantically scrambled to raise funds, but it was already too late. No one could halt this runaway train. On November 8, 2022, FTX temporarily suspended customer withdrawals. This was the decisive moment of collapse. Days later, it was forced to file for bankruptcy. The misappropriation of customer assets came to light, leading to a barrage of criticism against SBF. He had, in fact, engaged in massive fraud behind the facade of effective altruism. The damage amount was said to be 7 trillion yen, ensnaring investors worldwide. The entire cryptocurrency market plunged into chaos, and trust plummeted. SBF was arrested in the Bahamas and extradited to the United States. His empire, built on pretense and falsehoods, crumbled overnight. In court, he was charged with multiple crimes, including fraud and money laundering. His life, once marked by brilliant success, took a dramatic turn into darkness. Ultimately, SBF was sentenced to 25 years in prison. It was an undeniably tragic end for the man, once dubbed the Crypto Emperor. The FTX collapse left a deep scar on the cryptocurrency industry. It powerfully demonstrated the tragedy that results from a lack of regulation, transparency, and ethical conduct. Many lessons are to be learned from this failure. The risks lurking behind dazzling success, human hubris, and the critical importance of organizational governance. Why did FTX's success become the seed of its failure? Because an excessively grand success desensitized the executive's ethical compass. Who overlooked what? The structural irregularities hidden behind SBF's charisma, coupled with lenient regulation, exacerbated the damage. What is the lesson for the modern era? That no matter how innovative a venture, without fundamental financial ethics and transparency, it is merely a house of cards. From this tragedy, we must learn the importance of building a more robust foundation for future innovation and growth. FTX's failure presented us with an unavoidable lesson that the new frontier of cryptocurrency must confront. The quality of decision-making in complex financial markets will differ significantly between those who understand this failure and those who do not. We must always maintain a clear perspective to learn from past mistakes and avoid future risks.